It wasn't a computer glitch, it wasn't a rogue trader, it wasn't even a sudden shift in the fundamental economic data, it was a structural liquidity vacuum, the kind that appears when everyone tries to exit a burning theater through a cat flap. History remembers the crash, it remembers the red arrows. It remembers the panic, but it rarely remembers the positioning that made it inevitable. We are seeing that positioning again right now, hidden in plain sight, buried in the footnotes of quarterly filings. Obscured by complex derivative strategies, but the signal is flashing bright red. The largest asset manager in the world is moving, BlackRock is adjusting, and if you know how to read the tape, the message is deafening. They are preparing for a repeat of 1987, not necessarily in speed, but in structure. The mechanics are identical, the leverage is higher, the liquidity is thinner, and the date on the horizon is January 2025. Most people are looking at the election, they are looking at interest rates, they are looking at GDP. They are missing the forest for the trees. The smart money isn't betting on growth, they aren't betting on a soft landing. They are positioning for a liquidity event. This isn't prophecy. It's positioning under constraints. When you manage $10 trillion, you cannot hide. You cannot day trade, you are the market, and when the market moves to safety, it crushes everything in its path. The pattern is unmistakable. The arithmetic is merciless. We have seen this 3 times before, 3 specific moments where the elite exited early, leaving the public holding the bag. To understand January 2025, you have to understand October 1987. You have to understand the mechanism of the crash, not the news headline, the plumbing, because the plumbing is about to back up again. To understand the gravity of the signal we are seeing today, we must strip away the noise of the daily news cycle and look at the raw mechanics of how large capital pools operate. When an entity the size of BlackRock, a firm that effectively owns a significant percentage of the entire S&P 500, begins to alter its stance, it does not do so on a whim. It does not do so based on a gut feeling or a television pundit's recommendation. It moves based on mathematical constraints. Specifically, it moves based on liquidity constraints. The trade we are analyzing is not a single stock purchase. It is a structural rotation. It is a defensive posture that prioritizes the return of capital over the return on capital. This is the exact same behavior we saw in the weeks leading up to the most notorious market dislocations in history. The media calls these events black swans. They call them unpredictable disasters, but for those watching the flow of funds, they are as predictable as the tides. The incentive is preservation, the risk is total systemic lockup, and under these constraints, the rational move is to sell into strength. Before the liquidity evaporates, let's open the first case file, OC87. The Black Monday crash. Most observers agree this was the first modern financial crisis, the first time computer-driven trading models collided with human panic. But the story you have been told is likely incomplete. The standard narrative blames program trading, it blames a computer glitch. That is a comforting lie. It suggests that if we just fix the code, we are safe. The reality is far more disturbing. The crash of 1987 was caused by a product called portfolio insurance. This was a strategy sold to every major pension fund and insurance company in America. The promise was seductive. The bankers told these massive funds that they didn't need to hold cash. They could stay fully invested in the stock market, capturing all the upside. If the market started to fall, the computer models would automatically sell S&P 500 futures contracts to offset the losses. It was presented as a risk-free trade. A perfect hedge. Think about what that means. The entire institutional world was positioned on the same side of the boat. They all believed they had an exit door. They all believed that when the market dropped, they could sell, but they forgot the most basic law of markets. For every seller, there must be a buyer. On the morning of October 19, 1987, a Monday, the market opened lower. The portfolio insurance models woke up. They saw the drop. That is the equivalent of the Dow dropping over 9,000 points in a single trading session today. It was physical violence. The smart money had already moved. In the weeks leading up to October 19th, there were signs. Poll Tudor Jones, a legendary trader, saw the pattern. He saw that the market was overextended. You cannot insure a burning house when the fire has already started. He positioned himself short. He didn't just survive the crash, he made a fortune. He understood the constraint. He knew that the system was fragile because everyone was relying on the same liquidity pool. When the stress came, the pool would dry up. The parallels to today are chilling. In 1987, the culprit was portfolio insurance. Today, it is the massive concentration of passive flows and volatility suppression strategies. The names have changed, the mechanism remains the same. The incentive is to dance until the music stops, but the music is slowing down. Now let's go further back. Case file number 2. October 1929, the Great Crash. The cultural memory of 1929 is black and white photos of men in fedoras selling apples, but the mechanics of the crash were driven by leverage, specifically margin debt. In the Roaring '20s, the average investor wasn't buying stocks with their own money. You could put down 10% cash and borrow 90% from the broker. This worked beautifully on the way up. But leverage is a double-edged sword. The constraint in 1929 was the margin call. When the market dipped, the brokers didn't ask politely for more cash. They sold the stocks immediately to cover the loan. This created the same feedback loop we saw in 1987, but at a much slower, more grinding pace. The trigger came in September. It is known as the Babson break. Sooner or later, a crash is coming. They saw that the credit lines were maxed out. In the weeks before Black Tuesday, the smart money began to distribute. They didn't dump everything at once. They sold into the rallies. They sold to the retail investors who were buying the dip. They moved into cash. They were sitting on the sidelines with cash waiting to pick up the pieces for pennies on the dollar. The lesson here is about duration. And when the credit cycle turns, asset prices must fall. They felt rich. They were planning vacations. Within 3 weeks, they were insolvent, not just poor insolvent. They owed more than they owned. The psychological shock was so severe that it altered the behavior of an entire generation. My grandmother, who lived through this, would never throw away a piece of aluminum foil. She would wash it and reuse it. That trauma came from the sudden realization that the paper wealth was an illusion. The only thing that mattered was what you physically held and the cash you had in your hand. The incentive for the elite was to exit before this realization hit the masses. Case file number 3. The global financial crisis of 2008. This is the most recent iteration of the pattern, and it brings us closest to the modern mechanism. The 2008 crisis was not about stocks initially, it was about debt, specifically mortgage-backed securities. The banks had taken trillions of dollars of home loans, bundled them together, and sold them as safe assets. They were rated AA. They were treated as good as cash. Institutions all over the world held them as collateral. They used them to borrow money in the overnight repo market. This is the plumbing of the financial system. It is how banks fund their daily operations. The constraint here was counterparty risk. In 2007 and early 2008, the smart money started to realize that the underlying loans were bad. Goldman Sachs famously began to short the very index of mortgages they were selling to clients. They weren't being evil in a cartoonish sense. They were acting on the incentive to survive. They saw the data, they saw the delinquency rates rising in California and Florida. They knew that the AA rating was a fiction. When the market realized the truth, it didn't just fall, it froze. This is the critical distinction. In September 2008, after Lehman Brothers collapsed, the repo market stopped working. Banks stopped lending to each other. They didn't know who was solvent. They didn't know if the collateral was worth 100 cents or 0 cents, so they hoarded cash. The entire global economy runs on credit. When the credit stopped, global trade ground to a halt. Ships sat in harbors because no one could get a letter of credit. The warning signal in 2008 was the widening of spreads, the difference between the safe government yield and the bank lending rate started to blow out. The insiders saw this. They stopped rolling over debt. They moved to pure treasury bills. They got out of the commercial paper market. By the time the news anchors were talking about a crisis, the damage was already done. The positioning had happened months in advance. Those who waited for the official announcement were wiped out. Those who watched the liquidity indicators moved to safety. This isn't prophecy, it's positioning under constraints in all three cases, 1987, 1929, 2008. The pattern was identical. First, a period of excess and leverage. Second, a structural flaw in the market mechanics, portfolio insurance, margin debt, toxic collateral. Third, the insiders identify the flaw and quietly exit. Fourth, a trigger event exposes the lack of liquidity. Fifth, the public panic. Now, we must map this onto the present. We must look at the BlackRock trade and the signals flashing for January 2025. The current market structure is more fragile than 1987 and more leveraged than 2008. The rise of passive investing means that millions of people are blindly buying the index every 2 weeks with their 401k contributions. This creates a mindless upward pressure, but it also creates a potential air pocket. If those flows reverse, there is no active manager there to buy. The machines will step back. Current data suggests that the BlackRock trade refers to a massive accumulation of short-duration government bonds and cash equivalents alongside a strategic rotation out of consumer cyclical stocks. This is a defensive crouch. It is the posture of a fighter who expects to get hit. Why January 2025? The timing aligns with several converging cycles. The debt ceiling debates, the post-election realization of fiscal deficits, and the refinancing wall for corporate debt. Trillions of dollars of corporate debt issued during the low-rate era of 2020 and 2021 is coming due. It must be refinanced at much higher rates. The arithmetic suggests many companies cannot afford this. They will face a liquidity cliff. The constraint engine today is the U.S. Treasury market itself. The government is issuing debt at a pace that the market is struggling to absorb. The term PREMIUM, the extra return investors' demand for holding long-term debt is rising. This is the market screaming that it perceives risk, not just market risk, but fiscal risk. The risk that the government itself is caught in a debt trap. When the largest players see this, they shorten their duration. They don't want to hold a 30-year bond. They want to hold a 3-month bill. They want to be as close to cash as possible. This brings us to the counter-argument. You will hear analysts say, but the Fed will pivot. The Fed will print money. They won't let the market crash. This is the Fed put theory. It is the belief that the central bank is omnipotent, but there is a flaw in this logic. The Fed can print money, but it cannot print value. It cannot print oil. It cannot print supply chains. If they print into a supply-constrained economy, they get inflation. We saw this in 2022. The Fed is now constrained. If they print to save the stock market, they reignite inflation. If they fight inflation, they crash the market. They are trapped. The smart money knows the Fed is trapped. That is why they are positioning for volatility. They know the Fed put is either gone or the strike price is much, much lower than the public thinks. So where does this lead? The endgames are fixed. History gives us a menu of 3 options. The first is controlled decline. This is the Japan scenario. The central bank manages a slow, grinding bear market that lasts for decades. The nominal prices might stay flat, but the real value drops. This preserves the institutions, but destroys the saver. The second option is chaotic collapse. This is 1929 or 2008. The system breaks. The leverage unwinds violently. Institutions fail. This leads to a deflationary shock, followed by a massive government response. This is the most painful option in the short term, but it clears the dead wood. The third option is reset and restructure. This is the historical precedent of 1944. Bretton Woods or 1971, Nixon shock. The rules of the game are changed overnight. The currency is devalued, the debt is restructured, capital controls are imposed. This is the executive order scenario. It usually happens after a chaotic collapse. As the solution, the BlackRock positioning suggests they are hedging against. Option 2, chaos, to be ready for option 3, reset. They are holding the assets that survive the chaos, short-term treasuries, hard assets, and infrastructure, and shedding the assets that rely on the everything bubble. The pattern repeats in 7 distinct stages. Stage 1. The new era narrative. Investors believe the old rules don't apply. Valuations detach from reality. Stage 2. The smart money exit. Insiders see the liquidity constraint and begin to distribute stock to the public while hoarding cash. Stage 3. The trigger. A specific event, a failed auction, a bank failure, a geopolitical shock, exposes the fragility. Stage 4. The liquidity vacuum. Buyers disappear, spreads blow out, the safe assets are sold to raise cash. Stage 5. The public panic, retail investors capitulate, news headlines scream apocalypse. Stage 6. The policy response. The central bank or government intervenes with emergency measures, often changing the rules of the currency or banking system. Stage 7. The new equilibrium. Wealth has transferred from the weak hands to the strong hands. The cycle resets. We are currently in late stage 2. The distribution is happening, the volatility is being suppressed, but the pressure is building underneath. The BlackRock trade is the signature of stage 2. It is the sound of the lifeboats being lowered while the band is still playing on the deck. The only variable is timing and pain. If you are listening to this, you have an advantage. You have the data, you can see the pattern. The preparation is not about gambling on the exact date. It is about resilience. It is about ensuring you are not leveraged. It is about ensuring you have liquidity when others do not. It is about understanding that when the tide goes out, you want to be standing on solid ground, not swimming naked. Subscribe to the channel. We will continue to track these liquidity flows. We will continue to monitor the bond market signals. Do not let the daily noise distract you from the structural reality. Educate yourself on history. Watch the data, not the headlines.